You can reintroduce yourself.
Who knows who I am?
What's going on? Okay. That was a side note. Anyway. All right, you're live. Have fun.
Morning, everybody.
Morning.
I'm actually not going to answer any questions. He's going to answer them. I'm just here to read.
And buy lunch.
That's it.
Not a bad idea. And buy lunch.
Put on the phone.
Go.
All right. Any questions before we proceed?
How old are you? What do you do?
Huh?
How old are you? What do you do?
How old am I? 12.
This is the Mortgage Anonymous. Introduce yourself.
My name is Ricardo Leal. I'm 31, since you need to know age. I've been working in banking in the mortgage industry for 12 years. It's been a long journey, a lot of different moves, learning a lot throughout the whole way. And I tell everybody you can never learn enough. Every day, it's always a learning process. You're always learning something new. Anybody who says differently is somebody who is probably going to fall out of the business, or they probably don't know anything at all. We're actually teaching my favorite chapter in the mortgages from this book. It's something that I touch on almost every single day, conventional, FHA, and VA loans once in a while. If you guys have any questions when we're going along, please don't hesitate to ask. Except Bob, you can hesitate.
Can I ask a question?
Yeah.
What's a loan originator? What do you do, basically?
Nothing.
What do I do?
As a loan originator?
To be honest, I don't know. I don't even know what I know. Just kidding. I put together loan files. So I sit down with clients in the beginning, normally before the realtor goes out and does their job, to figure out what they're qualified for based off of what they're looking for. And then my job is to make sure that they're going to be able to qualify for that loan and close on it. And the realtor will always stay satisfied because they know they have the confidence that we're going to bring them all the way to the end. So my job is take documents from the clients, analyze them, see what it is that they're going to be approved for, give them pre-approval, and then when the house is found and you're on the contract, I put together the loan file to make sure that we're going to be able to get approved. Any other questions? All right, let's move on.
It's the law. There you go.
All right. The amount of a mortgage loan in relation to the value of a home is a loan to value ratio. Any questions on that? I think that's one of the most important parts of a mortgage is the loan to value ratio. Meaning that whatever the amount of the loan is versus the value of the house or the offer on the house will be the loan to value ratio. Okay? LTV. Any questions on that? All right, let's move on. All right. The word amortized means to kill off slowly over time. That's what an amortized loan does. It kills off a debt over time through periodic payments to the lender. So amortization, depending on how many years the loan is for, you're going to have a payment fixed or maybe adjustable throughout the period. And by the time you get to the end, it'll be over, which is a fully amortized loan. All right. At the end of the term, the full amount of the principal has been paid off. Such loans are also called self-liquidating loans. Get used to this stuff.
You're getting used to it, I know.
All right. A fully amortized loan is the most frequently used plan. It requires the mortgager to pay a constant amount, usually each month. This is what you're going to see a lot of out there today, fixed rate loans. A lot of people try to stay away from other types of loans, like adjustable rate loans or balloon payment loans, and you're going to see that later on in this chapter. But this is what I wanted to say is maybe accounted for maybe 90% of the time in today's originations. Right. Let me know if I'm going too fast, guys. When a mortgage loan requires periodic payments that do not fully amortize the amount of the loan, final payment is a larger amount than the others. This is called a balloon payment. And this type of loan is called a partially amortized loan.
So what's the difference between the fixed and that?
Fixed and this one. So when you do a balloon style loan, you don't see that anymore unless you're doing maybe commercial. You will have an amortization period. Most of the times it'll be like 15, 25, 30 years. And when it comes time for the balloon term, so let's say they tell you, okay, this is going to amortize over 25 years and it's going to balloon in 10. So your payment is based off of a 25-year loan, but after year 10, the whole balance is due. So it's either you pay the entire principal or you refinance into another loan. Okay. Any questions on that? Good.
Make sure you ask questions. It's a lot of stuff today.
Right. Bi-weekly mortgages involve half payments every 2 weeks instead of monthly. Some borrowers misunderstand this as twice a month, but it involves 26 half payments, the equivalent of 13 monthly payments a year. The extra money applied entirely to principal can reduce time on a fixed rate loan from 30 years to 22 or 23 years. Does anybody understand that? Huh?
You pay less interest on that option?
Well, you're going to pay the same interest. You're going to have, well, the interest amount, no, but the interest rate will remain the same. But because you're making extra payments every single year, you're going to be paying less interest compared to whatever the amortization table is that they provide you with. Okay? Because a lot of people misunderstand this for twice a month, 15 days every single month, but bi-weekly is 14 days. So you do the math, 52 weeks, 26 payments, you have the equivalent as if you're paying 13 months in the year. So that extra month will go straight to principal and will reduce your term because you're going to be paying off a lot faster.
Okay, you're not saying that, let's say if the mortgage payment is $3,000 per
Yes.
month. Are you saying, on this example, you divide $3,000 in half?
Yes.
You pay $1,500 at the beginning of the month, by the 15th, and then, no, at the first, and then on the 15th.
Let's say the
you pay
14th, the 1st, the 15th, and then you're going to be paying again on the 29th.
So basically, you make one installment a month, but you divide the installment in half.
Yes. And you pay it every 2 weeks instead of every 15 days.
And you have to make that arrangement with the loan company, with the mortgage company?
Yes.
Or you have to do it alone, or you can do it alone?
It depends. So my recommendation, when you start, call up the company, let them know that you want to do this. Some of them will entertain the idea and they'll tell you how you need to pay it. Other times they may not entertain the idea, and it's up to you to make sure that even though you're paying every 2 weeks, that you're going to satisfy that month. Okay?
In other words, you gotta pay the month plus whatever.
No.
Yeah, you got to make sure that when you're making that every 14-day payment, so like let's say you start on the 1st, let's say today's the 1st, so you make a $1,500 payment today, and on the 15th you make another $1,500, and on the 29th you make another $1,500. Now you're ahead of the game for the following month.
But
So you'll be fine.
doesn't become late payment if you pay by the 15th, because they give a grace period of,
15th.
but.
But I'm saying, like, if it's due, like, let's say you start off, your payment is due on the 1st, you could be a month, you're already a month ahead of the game by the time you get to the 29th. Or even if you pay off on the 15th, the 15th is normally the grace period.
You don't get a penalty if you
No.
pay it by.
What's the difference between paying every 2 weeks or pay 1 month ahead? Or let's say, I don't wanna pay every 2 weeks, okay, like, for argument's sake, the bank doesn't agree with the bi-weekly payments. And I say I pay January, I pay February, yada, yada, until June. I'm gonna have extra money, I'll throw another extra month in that, will that be the same thing? Same result or will be different?
It'll be the same thing. Basically, it'll be the same thing. You're gonna be a little bit ahead of the game because by the time the next month is due, you're gonna have about $1,500 extra, and you'll always have that kind of rolling over until by the time you get to the end of the year, then you'll be a full 3,000 in your
Will the
scenario.
result will be the same if you pay an actual month, the next pay and a month?
So let's say instead of doing that bi-weekly and you divide one payment by 12 months and you put that installment every month, it'll be the same thing basically. Some people just have it this way because it's a lot easier for them to just make that bi-weekly payment.
Yeah.
You know?
I'm assuming the only difference will be the interest rate calculation. If you pay bi-weekly or if you pay 1 month.
Right.
Yeah.
Right.
You have a better result by doing bi-weekly than
And
just
do it
doing
every
1
month.
month. Well, because you prepay, so you don't get
Say
interest
15
calculation.
days of interest, that's what you do every month.
Every month. You're basically, you're kind of cutting down the time by putting that in.
Right.
I had an argument with a family member once about that where he said he used to hold the whole money until the end of the year, and I was like, well, if you do the math, depending on how much the loan is, you're going to be saving about $1 something every single month in interest. It's not going to be a whole lot, but by the time you get to the end, your term will be significantly reduced. Okay. Any other questions? No? All right. Adjustable rate mortgages, known as ARMs, shift the risk or reward of changing interest rates from the lender to the borrower, with corresponding changes in the monthly payment.
Is that a good loan or bad loan?
Depends. Could work in your favor, it could work against you. Depends on where the interest rate environments are. All right. I believe it goes into a little bit more depth where I think you're going to be able to understand where this could hurt or help you. Right. The adjustment period. This is the anniversary on which interest rate adjustments may be made. The index. The interest rate on the loan may go up or down following the trend for interest rates across the country. The most commonly chosen index is the rate period on 1-year U.S. Treasury bills. I'll go into this in a second. I just want to read through the bullets real quick, and then I'll explain to you what each one of these things mean. So, margin. The borrower pays a specific percentage above the index. That percentage is known as the margin. With a 2% margin over Treasury bills, the borrower would be charged 4%. Go ahead. Cap. A loan agreement may be set a cap or on, for example, 2% any single adjustment. Sorry. Depending on the particular mortgage, the extra 1% might be treated 1 to 3 ways. It could be saved by the lender to be used at the next adjustment period, even though the rates had fallen in the meantime. Could be absorbed by the lender with no future consequences to the borrower. The shortfall, the unpaid 1%, could be added to the amount borrowed so that the principal would increase instead of decreasing, resulting in negative amortization. All right, ceiling. A ceiling, sometimes called a life cap, is a maximum allowable interest rate. A ceiling allows the borrower to calculate the worst case. Okay, this gives you a little example. Worst case. If a 30-year adjustable loan for $150,000 costs $1,100 a month for principal and interest, that's 8%, and if the ceiling is 5%, the worst that could happen is that the rate would go to 13%. The borrower can calculate in advance that would cost $1,659 a month. So right off the get-go, this person could see whether or not they're going to be able to feel comfortable with those payments.
Is it similar to the adjusted rate?
What is it?
Is it similar to the adjusted rate?
Actually, all of these are components to the adjustable rate mortgage. Okay, let me just explain that a little bit for you guys. Okay, so you start off today. Let's say you're going to try to entice the buyer to go work with you. So you're going to start off with a 3% loan. So they're going to promise you for a fixed period 3%. So that's going to be the initial fixed period. So most of the times you'll see like a 3. supposed to use a pen, Bruno, to work on this, or a stylus?
Right there. Should be right in front of the monitor.
Oh, okay. Alright. So let's say you have a 3, a 5, and a 7 year. A lot of the times when you have the shorter term, they're going to give you the better interest rates. They're going to try to entice you to go with that one. 5 and 7. Most of the times what they'll try to do is each one of the periods over here up to like a 10 year will be better than what you would normally get on a 30-year fixed period. Okay, so whatever interest rate you start with is fixed for that term. Okay, so if it's a 3-year initial cap, it'll stay at 3%. Let's say for an example, we're going to start off with the 3%, and let's say it's going to be for 5 years. Okay, so they're going to give you what's called a margin. A margin is going to be fixed for the entire term of that mortgage. Okay. A margin, let's say the margin is going to be 2%. Okay. Now, the index, this is where, where your question asked if it'll hurt you. Depending on what the index is, that's where you're going to see whether or not it's going to work in your favor. A lot of the times that you see today, a lot of them use LIBOR or sometimes Prime. Sometimes you also see the Treasury bill. Right now, a lot of them are using LIBOR, but they're going to go away with that because LIBOR is going to be done with supposedly in 2021. But let's say for argument's sake, when we start this mortgage, the index is already 2%. So a lot of the times they're going to start you off lower than what you would be if it was index plus the margin. Okay? Let's say that in 5 years from now, nothing is going to change. We're going to remain even. Nothing happens in the index. So once that happens, you will be adjusted to 4%. Okay? And then what they do also is they give you a cap per adjustment period. So let's say they tell you, okay, every time that it adjusts, the most that it will go up is 2%. So your cap is 2%. They're also going to give you what's called the ceiling. Apologize for my handwriting ahead of time. This is what you see a lot of. There's also a floor as well. But most of the time in today's market, the floor will be what you start off on. So you'll never go lower than, for example, 3%, as in this example. But there were some people that, when we went through the last recession, they actually benefited heavily on that, because even though they were in adjustable rate mortgages, depending on what index that they were using, it actually went down. I actually took a class where the professor told me that he was getting 2% on his mortgage. That was the interest rate he was paying during the time that it went through that recession and it adjusted. So he was actually paying 2%. So for him, it benefited heavily because there's no way to find a 2% mortgage out there. Hasn't gotten to that point yet. Okay? So the floor, let's say for this example, is 3%. Now, depending on the adjustment periods after that is what's going to make this either a good adjustable rate mortgage or a bad one. Most of the ones that you see today, they adjust yearly after the initial period. So let's say the adjustment period is yearly. So every year, depending on what the index and the margin is, you will see fluctuation in your interest rate. Okay, it could go up, it could go down. Let's say after this period here, let's give a worst case scenario. The index is now 6% and your margin originally was 2%. That will never change. Now we got 8%. Can anybody tell me, if we had this cap, how much would we adjust on year 5?
You can't go no more than 2%, so what should be 4?
Anybody else? Hmm?
But you usually have 3, so it'd be 5, sorry, 3 and 2 is 5.
Yeah. No, you could. I just want to make sure if everybody understood it. So then you have 8%, which is the margin plus the interest, but since there's a cap for it to go up, most of it will go up as 5%. So at that adjustment, you're going to get 5%. Right. And then if it continues that way, eventually when you get to the 2 years after that, you'll get to 8%. The next year will be 7%. Okay? Any questions on that? No? Okay. Negative amortization. As a result, the debt increases rather than taking its normal downward path. Process is known as negative amortization. So some loans, even though the interest rate adjusts, let's say they tell you that you're going to have a fixed payment, what happens is to that extra amount that it was supposed to adjust for that you're not paying is going to go back into the loan. So rather than your principal going down, your principal will go up, called negative amortization. That's not a good loan to have. No.
Question.
Yes.
So if you started off with a fixed rate, can you, and I know, God forbid, I'm just saying, I know, I could project in the next 3 years there will be a recession. I know the interest rates are going to drop. Can I switch to?
Can you do it on you can always refinance it to an adjustable rate mortgage.
I'm just saying, God forbid, okay, that's what I said.
Just kidding.
It's very risky. It's very risky. Some people, in my opinion, if somebody were to come up to me and tell me that they wanted an adjustable rate mortgage because of the interest rate, I would have to let them know worst case scenario. But then for me, it would make a lot of sense. You know those people that travel a lot for their job? Let's say you work for Amazon and you're going to be working over here in Newark for 2 years, and then they're going to send you to Washington 2 years after that. So you know you're only going to be here for 2 years. Let's say you took the nicer interest rate with that 3-year fixed period, that would make sense. Because by year 2, you're going to be selling the house. You'll never make it to that adjustment period. Okay? Convertibility. The borrower may choose to change the mortgage to a fixed rate mortgage at then current interest rate levels. So some mortgages may be convertible. In the event that you tried to do something like that and something terrible happened and the economy went up and you weren't anticipating that, you can call the bank and see if you can convert it into a fixed rate mortgage. And what they'll do is they'll give you whatever the fixed rate is at that period, at that point in time. Okay? Any questions? Am I going too fast? I'm going to slow down? Or we're good? Okay. Initial interest rate. With many loan plans, the rate during the first year or the first adjustment period is set artificially low, called the teaser rate, to introduce the borrower to enter into the agreement. Okay? So a lot of the times they'll make it look extra nice just to get you to get into that type of loan. And a lot of people actually did. And a lot of them got in trouble because when we did have the recession, interest rates were super high and the value of the house was super low. So getting a refinance at that time to get out of an adjustable rate mortgage was basically impossible. So that's the kind of the downfall also in adjustable rates. Okay. Assumability. Some arms are assumable by the next owner of the property, usually with the lender's approval and the payment of 1 point or more in service fees. Okay, so let's say you decide to sell the house and the new owner wants to assume your mortgage because he thinks that's such a great idea. You may be able to just contact the bank and they will assume the mortgage in their name, but there may be fees associated with it, maybe a percentage of the loan, 1%, 2%, or whatever other fees the bank may have.
So more like a semi-closing all over again?
I'm sorry?
More like a semi-closing all over again?
Kind of, but what they'll do is they'll take over the mortgage.
So okay, let me give an example. So if I have a house that's in my sister's name and I want to assume that mortgage, I go to the bank, show them like, hey, I've been paying the mortgage all the time. So that would consider like, would it just transfer over or do I go through appraisal and all this other stuff before the bank can do this?
Normally when it's assumable, there's no, it simply goes into your name. Okay. I mean, whatever the bank's process is, you have to figure that out with the bank. Some of them will not even allow you to assume it. They'll just tell you you have to refinance the start of the loan. But like, let's say you're on year 3, on a 30-year period, you'll continue on year 27. Because you're just going to take over You're gonna have 27 years instead of 30. I mean, you're gonna take over from where you was left off. Okay. Cool. Any questions?
So good morning.
I'm not sure there is many assumable mortgages out there. I know VA does allow you to assume a mortgage, a veteran to a veteran, but I don't really hear too much about assumption of mortgages.
I'm interested in one.
Huh?
I'd like to do one.
You'd like to do one? Yeah. Oh, listen, if you could get a good deal on it, go for it.
But the interest rate don't change when you assume
Yeah,
it.
exactly.
The interest rate doesn't change when you assume it.
No.
You take on the same interest rate.
You're basically going to take over whatever the mortgage was at that point. Okay? All right, interest-only loans. Interest-only mortgages which have lower monthly payments because the debt is not being amortized. If prices stop rising or even fall, owners who had to sell might find themselves underwater or upside down, owing more than the house would bring in a sale. Okay? Let me just touch base on this one real quick. Interest-only loans. So a lot of people before the last recession were doing these types of loans just because it was easier for them to qualify. You're paying an interest-only payment, so your payment's obviously going to be a lot lower. And then it's up to that person whether or not to apply money towards the principal during that period that is interest-only. So let's say you did a 30-year mortgage at that point. They would offer you a 5 or 10-year period at interest-only, and then your loan would start amortizing on year 5 or year 10. So the payments would go up at that point because now you're paying into the principal. A lot of the people found themselves in trouble with this because when it came time out of the interest-only period, they would not be able to refinance because, again, the house wasn't worth what they owed.
So the benefits from this don't have.
The bank benefits from this heavily. Oh yeah. But it was something that a lot of people did. Some people were smart and they put money towards the principal, and some people they just, hey, listen, I can go on more vacations every year, I can buy nicer things. Then time for the loan to start amortizing, and they found themselves in trouble. All right. All right. Interest. Charge for the use of someone else's money is called interest. All right. On an amortized loan of $100,000 for 30 years at an annual interest rate of 7%. For who? Or compared to what? When you're talking about like the last 10 years, yeah, that's high. But if you go 15, 20 years ago, that's not high at all. $665.31. The amount due after the first month's payment has been made can be calculated in 4 steps as follows. So you take $100,000 times 7%, you get $7,000 annual interest. Okay, now since you're paying your mortgage monthly, you got to divide that by 12. And that's how you're going to find out how much interest you're going to be paying that month. So in this calculation, it comes out to $583.33. You have already the $665.31 monthly payment made. So you subtract the interest from the payment made, and that's how much money gets allocated to the principal. Okay, so you start the month with $100,000. You make your first payment, and now what you owe the bank, or your principal, is going to be $99,918.03. All right, does that make sense? Okay, just check something real quick. All right. Now we're going to do a little exercise because you guys are going to need this for the test. All right. Depending on what the question is, they're going to ask you, okay, how much principal are you going to owe after payment 1 or payment 2, based off of a loan of this much, an interest rate of this much, and the way that they're going to, what they're going to give you is going to give you this chart. Okay, so what you have to do is you take a look at the term. So on the top section, you're going to see the rate on the left side, and across the top, you're going to see the term. okay? So in the event that they tell you that you're gonna be having a 30-year loan at, let's say, 5.25% interest, you're gonna go to 30 years, 5.25%, and you're gonna have $5.53, okay? So it's important. So we're gonna take that $5.53. How do you clear out the whole thing, bro?
Raise.
You have to actually erase, or, huh?
That's back on top.
Oh,
Green.
okay. So, sorry, what was that? 30 years? 5.25%. It's $5.33, right?
53.
Oh, $5.53. Sorry about that. Okay. Let's say you have a $250,000 loan. So, $250,000 loan. So the way that it works is, since it's per thousand, we're going to divide 250,000. Get 250, right? So you're going to take this 250. You're going to multiply it times $5.53. Correct. 1382.50. Okay. So what you're going to do is you're going to take 250,000. Okay. And you're going to multiply that times 5.25%. Okay, 13,125 divided by 12. $1,093.75. Okay. Now your payment is $1,382.50. Now remember, this $1,382.50 is going to be for the life of the loan because we have a fixed rate mortgage, 30 years at 5.25% interest rate. So we subtract 1,382.50 by 1,093.75. $288.75. Okay, so you take 250,000 minus 288.75. You're going to get $249,711.25.
So what are we trying to do here? Find out the first payment?
Yep.
Principal?
Let's say the question was, find out what your principal is going to be after your first payment.
Oh.
This is the steps that you're going to take to get there. Does that make sense? Does anybody have any questions?
Let's round it off.
No questions?
What's the 279, 711.25 again? What is that, the remaining of the loan?
249, 711, 25. So if the question is, what is the principal balance going to be after you make your first payment? This is the calculation. Okay.
Is this chart, is there a way to calculate that without the chart? Or you need the chart?
You need a mortgage calculator, which you can't bring with you to the test.
So we'll have
They'll provide you with this, like, yeah.
Yeah.
You taking pictures of the title?
No, I'm going to bring
Those.
Hold on, hold on. If you're gonna take a picture, let me just at least fix this real quick.
Yeah, it didn't come out any better.
Take a picture now? All right. Since everybody understands the concept, I want you to do a little exercise for me. 30 years. Is your loan. 7% interest rate. Find out for me on the second payment. What's the principal?
Okay, so what is the loan amount?
300,000. Loan amount. Who's got the answer so far? A little more time for everybody else. I have to calculate.
So are we bringing calculators to the exam? Can
I believe you get a basic calculator.
we? Yeah.
It's on the screen.
Huh?
They have it on the,
On the screen, right?
yeah.
Oh, very, very basic. And they give you some scrap paper too, right? And they gotta give it back at the end, something like that.
You have to keep it close, that's it.
Huh? That's all you need to keep?
That's it.
I do like a cavity search, man, when you start. When I took the mortgage, I was wearing glasses, they made me take it off to make sure that I didn't have any answers. But I also didn't have any answers or anything written inside my,
Are you serious?
yeah.
Can you read? I don't think you
I don't think so.
can.
Right? Everybody good?
So,
Yeah?
Not sure we're gonna go over the steps.
Yes. All right. So we have 30 years, and I said 7%, right?
Yes.
So the multiplier that we're gonna get, the payment is gonna be on the 30-year column, you're gonna go to 7%, you have 6.65. Okay? So we get 300,000 times 6 points, oh, sorry,
oh, 300,000?
300,000.
When I did the calculation on the 50, then
That's okay. Divided by 1,000. That was 300.
my numbers are wrong. Okay.
So it's 300 times 6.65, right?
Yeah, 160.
Equals 1662, 300?
1995.
Yes, 1,995. So you get 1,995. That's going to be your monthly payment per month. Okay? That's your monthly payment. Is everybody with me so far? Good? So you get 300,000? Yes.
Where did you find that 6.65?
6.65
On the
is
chart.
on the
Oh,
chart.
we have to have this chart?
They're going to give it to you.
Oh, okay.
Yeah. You're gonna have this chart, so the first step is you're gonna find out the term versus the interest rate, find out what that payment is going to be over the year, over the term. Okay, so every month, you're gonna pay that monthly payment all the way up until the last one. Okay? So we take 300,000 times 7% equals 21,000.
What?
21,000. So you take 21,000 divided by 12.
Oh, you did it there.
Huh?
I know the lazy.
1750.
Correct. 1,750. Okay, so you get 1,995. 1,750 equals, was that 245?
Yeah.
245. So we're going to take 800,000 minus 245.
29975.
299,755. Yep. Are we done?
First month.
No.
Because we said second payment, right?
Right. Not that soon.
Okay. So now we got to do the same process all over again from this point down. Payment's going to stay the same, so you don't have to calculate that all over again. So we're going to take 299,755 times 7%. $20,982.50. Divide that by 12. This is 20,000. 982.50 divided by 12. 1748.57. Okay. You have 1,995 minus 1,748.57 equals 246.43. What is it?
I got $20,902 and 85 cents. You have 50 cents. That make a difference?
20,982.5, right?
0.85. Am I wrong?
299.
755 times
20,982.50. Oh, 82.85. I'm sorry. Good catch. That's hard. 1748.57. Oh, you know what? I wrote it down wrong. I was continuing doing the calculation on my calculator. I was just apologizing. So you still get 246.43. So now you're going to take 299,755 minus 246.43. Your new principal balance, so you get 299.
299,508.57.
That's correct.
299,508.57.
Everybody get that? No? Yeah, okay. A little bit confusing, but you guys will get the hang of it, okay? Make sure to practice this, later on today, when you guys have a little time, so that this continues fresh in your mind and you get the hang of it. Because I think there might be like 2 or 3 questions that might be based off of this, just off of this chart alone. Okay? Any questions?
Right.
No?
So if if they wanna know how much, balance will be after the 10th payment, you gotta take the 7% from the remaining balance from the previous amount and do the process again.
Correct.
Till you get 10 times,
Correct.
the 10 times, okay.
So now do you see why you would save money if you pay down directly towards principal with that bi-weekly payment? Because now your principal is gonna be going down a lot faster. So your interest payment will be smaller and you still have the same payment. So eventually your principal goes down faster and faster and faster.
But it's a fact, I pay my mortgage every month and I put more money in the principal, do the same?
It's the same thing,
Oh, okay.
the same thing.
Because I do like that, all the time I try to, before I didn't know, but one day I was reading my paper they gave me, and I saw that and just, I was paid maybe for 6 years, and I paid $199, $90, I said, oh my God, for 6 years I pay this, and then I start to put more money in the principal.
Yeah, because if you only go based off of the minimum payment, you're gonna only chip away a little bit at the principal for the first 12 years. After year 12, that's when you're gonna start seeing a lot more of the principal going down. You got a question?
Is this different at all if like taxes are rolled into a mortgage, or is that not?
Well, bless you. Taxes are rolled into a mortgage, they're not rolled into a
Or
mortgage.
rolled into your monthly payment?
Right. Then your monthly payment changes as your taxes also go up or down.
All goes up.
If you lived in the Ironbound during, what was it, 2015, I think, or 2016, they readjusted all the taxes because everything was super high. They actually went down.
I got a question.
Yeah.
If you pay PMI,
Yes.
where does your PMI go into the loan?
Where does the PMI go into the loan?
Yeah, I mean, does it become, when you determine the remaining balance, if you pay PMI, you have to go through the same process, you have to add the PMI and each installment?
So PMI is based off of the amount of money that you owe and the risk factors associated with the loan.
So within that $300,000, the PMI is already in
PMI has nothing to do with this.
there. Just to clarify, but if it is in there, will be $300,000.
PMI and the mortgage is completely separate in itself. Well, the reason why you pay PMI is it's less risk on the bank. So most of the times, the PMI will cover the top 25% of the value, right? So in case you default on the loan, they'll cover up to, well, they're responsible for 75%, and the mortgage insurance company will pay the remainder amount. Does that make sense? Or in the case of FHA, it's completely insured because it's PMI for the life of the loan, and the HUD will actually insure the entire amount.
But if you calculated how much is your principal balance, if you have a PMI, would the PMI affect
The principal balance? Not at all.
the PMI set, it's like a tax, so to speak?
It's like an added insurance.
It's added to the payment,
To the
payment
payment.
at the end of the month.
Right. So like, let's say, for example, this is completely off topic. Let's say, for example, you have your entire payment. So what we just calculated, that multiplier versus the amount of money of the loan in the beginning for the period, it's called principal and interest payment. So P&I, principal and interest. Then you have taxes, homeowners insurance, and then you get PMI or MIP depending on the type of loan that you have. And each one of these are in itself, okay? They're each individualized. They have nothing to do with one another, but you are responsible for that, which then gets rolled into something called your piggy payment, which is your mortgage payment. Okay? Does that make sense? So even though you're paying PMI, this and this have nothing to do with one another. They're completely separate in their own.
If you have a loan with the PMI, how long does the PMI stay in your loan?
Depends on the loan. Like let's say, for example, you start with an FHA with less than 10% down or 10% in equity, you're paying that for the whole life of the loan. If you have a conventional mortgage, depending on the bank and how they want to do it, most of the time what you can do to get away from PMI is after 2 years of paying the mortgage, you can call up the bank and ask them for a reevaluation of your house, kind of like another appraisal. And if your house is worth more, or should I say it's worth that much more, where your loan to value ratio is 80% or less, they'll eliminate your PMI. That's the bonus of having a conventional
Is
loan.
that the 2 years minimum, you said, or 1 year?
2-year minimum.
Has to be, that's standard.
You can ask your bank, but most of the time it's a 2-year minimum.
So if you do FHA with 10% or more,
After 11 years, has nothing to do with the value. After 11 years, it falls off. All right.
What's the average?
11 years, or did you use 11?
After 11 years, so I believe on your 12th, when you begin your 12th year, it falls off.
The $300,000 loan, how much would be the price of the PMI, more or less?
For a conventional or FHA?
Conventional.
It depends on the mortgage insurance company, and it depends on your credit, depends on your LTV, depends on the whole thing in itself. When they do their calculations on the PMI payment, it's based off of how much you owe, your credit score, the area that you're in. So if it's like a higher risk, so if you live in a state that's a higher default rate, your PMI is higher compared to a state that has a lower default rate. So it all depends.
All right, so let's say you're in Unicom and do a lot of loans in Unicom. What would be the average of a $300,000? Just a ballpark. You don't have to be so. Just to get an idea. $80.
300,000.
If you can remember.
There's a program called Home Possible.
Mhm.
So 300. I'm doing a loan right now. 305,000. He had a 745 score. He's putting 3% down. He's paying $108 a month.
Well, wait a month. Wait a second. That's like half that check, right?
FHA, I believe, is higher. So the FHA would be. Now remember, he has a 745 score. If he had a lower score, it would be much higher. So 300,000. So it would be about 212 for FHA. Yeah. Depending on the person, the program might be better for them to go with the conventional. But conventional is super sensitive when it comes to qualifications. All right. Oops. Any questions?
What's the minimum that you can put down as a down payment to eliminate the PMI?
To eliminate the PMI?
Yeah.
Well, there's actually loans out there that there are no PMI because it's rolled into your interest rate. So sometimes you can elect to have a higher interest rate and the PMI is already off.
If you put, let's say, $20,000 down payment, 20% down payment, 45%, you don't have to pay PMI?
20% or more, no PMI.
It has to be 20% or more, you don't pay PMI.
Exactly.
Okay.
All right. Any question? No? Points. When a new mortgage is placed, the lending institution may compensate for an interest rate below the current true cost of money by asking for extra prepaid interest in the form of upfront points, also called discount points. Each point is 1% of the new loan. On an $80,000 loan, each point would be $800. A charge of 2 points would be $1,600. Now, does that make sense? When you hear the term a point or the interest rate, a point is the equivalent of 1% of the loan amount.
Who gets the point, the mortgage company or who gets the point?
The more the bank.
The bank.
Bank. The reason why you would be paying those points is to get a better interest rate. The bank is going to take the bank is going to take a hit for the future of the loan, and you're paying them already upfront for it. Okay. And the same thing could work backwards. So you get a yield spread. You could elect to have a higher interest rate, and the bank will give you money in the beginning. Rate lock. Because interest rates change constantly, lenders may offer the borrowers the opportunity to lock in at a quoted rate. In this situation, the lender agrees to hold the quoted rate for a certain period of time. If the interest rate goes up, the borrower is protected. Does that make any sense?
Yeah.
Make sense, everybody?
Usually it's 90 days, right?
Depends. I'd like to wait until we're 15 days out and do a 15-day. Better rates.
15 days out and then lock for 15 days
Yes.
when you're ready to close.
When you're ready to wait from right that close to closing, you lock it in.
If it drops or if it goes up.
Well, because we are in an interest rate environment that's kind of going sideways, it makes a lot more sense to just wait to the 15-day unless something happens in the economy where we anticipate rates are going to go up, then we elect to go with the higher period, maybe a 30 or 45-day.
Is that across the rate lock?
So each rate lock, like if you compare like a 45, a 30, and a 15, it's about 0.3% for every 15 days. That's the loan amount.
But you pay to rate lock? Is that a fee?
It depends. Depends on the interest rate you lock in. If you lock in at a par rate, you don't pay anything. But if you lock in at a lower interest rate, there may be discount points associated. Or if you lock in at a higher rate, you might get money back through a yield spread.
Can you say that in English?
Oh, sorry.
If you want, I can say it in Chinese. I don't know how to speak English. Does that make sense to everybody? Yeah. All right. All right. Tax and insurance reserves. Most lenders require borrowers to provide a reserve or escrow fund to meet future real estate taxes and in some cases insurance premiums. The mortgage loan is made. The borrower starts the reserve by depositing funds to cover partial payment of the following year's tax bill and property insurance premium. Thereafter, the monthly loan payments requires of the borrower include principal, interest, taxes, and insurance reserves, also called PITI. So remember how I showed you guys what constitutes the payment? That's called the PITI, P-I-T-I. Okay, any questions on that?
No.
That make sense? All right. Your home loan toolkit, step-by-step guide. Although lenders are obligated to provide the booklet to borrowers within 3 business days of their completed loan application, no one is actually responsible for explaining the contents of the booklet. So, your home loan toolkit is step-by-step guide.
Do
So,
lenders really do that?
yes, they do. So we send out initial disclosures, and while the client, most of the time, does not read through it at all, because there's like 100 pages in there, they just click, 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 click. By the time they get to the end, they miss a 21-page home loan toolkit designed to explain to them the difference of different loans, how a loan works, the step-by-step guide of the buying process. If you want to go above and beyond as a realtor, try to explain this to the client. I tell my clients as a loan officer, when they get their disclosures, to download a PDF copy of the loan disclosures and read through it when they have time. Okay?
Usually that fills the bill.
That doesn't kill you.
They get so scared.
They do get scared. That's why we're there to calm them down. Explain to them step by step what's going on. All right, mortgage loans fall into several classifications. Conventional loans are those arranged entirely between borrower and lending institution. Government-backed loans include those insured by the Federal Housing Administration, known as FHA, or guaranteed by the Department of Veteran Affairs, called a VA. Both types, the actual loan comes from a local lending institution. Loans directly from the government include New Jersey Housing and Mortgage Finance Agency mortgages and rural economic community development, also known as the former Farmers Home. Home administration loans. All right? Now, as many people probably were listening to, your name is Louis?
Louis, yeah.
Louis. So me and Louis were having a conversation and you heard me mention the name conventional mortgage. We're going to talk about that right now. In making conventional loans, lending institutions set their own standards within the scope of banking regulations. Okay? Now we're going to go into private mortgage insurance. So banking theory holds that it risks depositors' money to lend more than 80% of the value of real estate, with any down payment below 20%. Therefore, a conventional loan must be accompanied by private mortgage insurance. The borrower pays a monthly premium for insurance that protects the lender in case of loss and foreclosure. For conventional loans placed after July 29, 1999, the federal government requires that lenders drop PMI coverage at the borrower's request when equity reaches 20%, and that coverage be dropped automatically when it reaches 22%. Equity is the difference between the market value of the property and the amount still owed on it. Sorry. Okay. So I gave you a little trick on like what you can do to drop it before it even gets to that point where you're at 80%. But most people don't know, if you don't call in when it makes your 80% of what you originally started with, it'll still continue. The bank is not obligated to drop it, but you can call and ask them to drop it because you already made it to that mark. Otherwise, you wait until you have 78% loan to value ratio from where you started, and it automatically comes off. Okay? Does that make sense? Banks are always out to get you, man.
Yeah.
FHA insured loans. It does not insure the property, but it does insure the lender against loss. The common term FHA loan then refers to a loan that is not made by the agency but is insured by it. Does that make sense?
Scroll back.
Scroll back to the first one.
I got it.
Good.
Carry on. Sorry.
FHA 203B. Most widely used FHA mortgage is FHA 203B, which may be placed on 1 to 4 family residences. An upfront single mortgage insurance premium, MIP, is charged at closing. It may be paid in cash or added to the loan. The FHA allows any or all of the down payment and closing costs to be a gift, not a loan from the borrower's relatives. In addition, a willing seller may pay the points and furnish money to establish the escrow account for the payment of future property taxes and insurance premiums. The seller's contribution, also known as seller's concession, may not exceed 6% of the loan. Does that make sense?
One FHA,
On FHA.
or by conventional.
Depends on the down payment.
Conventional, they don't allow more than 3.
It depends. If you put 25% down, they allow 9.
So the FHA is always standard 6%, right?
Standard 6%. Has nothing to do with how much you put down, just 6% across the board of the purchase price. Okay? Does everybody know what a seller's contribution or seller's concession means? Yeah?
Contribution towards the closing costs.
Or the buyer's closing costs, nothing else. Okay? So you can ask the seller for a credit since you're buying their home. It's a way to entice you to go ahead and buy the home. They're going to help pay for your closing costs. All right? So for FHA loans placed between January 1, 2001 and June 2, 2013, mortgage insurance can be dropped when equity reaches 78% of the original appraisal at time of purchase, but only after the first 5 years of the loan. Any questions? Good so far?
Not quite, I have a question.
Yeah.
Since we went back to the arm and assuming loans and stuff like that. FHA is assumable.
I've never heard of an assumable FHA loan.
Can you add somebody else into the loan?
Can you add somebody else into the loan at the beginning?
Throughout?
I don't believe you can.
Yeah.
You can call the bank and ask them if they will do it. But as far as I've heard, I've never heard of anyone assuming an FHA loan. I've heard of assuming a VA loan, not an FHA loan. I'm not saying it's impossible, but it's going to be at the discretion of the lending institution. Okay. Any questions? Okay. Estimate of value. The real estate must be evaluated by an FHA-approved appraiser. The maximum loan is a percentage of the appraised value. If the purchase price is higher than the FHA appraisal, the buyer must pay the difference in a higher cash down payment or may decide not to purchase. Does that make sense?
Yeah.
Yep. So if I'm buying a house for $300,000 and the appraisal comes in at $250,000, what amount extra am I liable to pay for out of pocket? Repair requirements. The FHA may stipulate repairs to be completed before issuing mortgage insurance on a specific property. Everybody understand that? Yep. So if something comes back on the appraisal like a broken tile or missing sheetrock, the bank is going to ask for them to fix that prior to closing so that they can assume the mortgage.
Or paint in between the doors.
Oh, they're very sensitive. Paint on the outside of the house, paint on garage doors.
In between the creases of the doors.
Yep.
Foundation, chipping.
Mm-hmm. Cracked steps, missing handrails, the whole nine. Huh?
That's understandable how it is.
Absolutely. Well,
And in between the doors, like, what child will go in between the doors and peel off the paint?
yeah. Well, it depends on the appraiser and how sensitive they are to taking those pictures. All right. So occupancy requirement. With certain exceptions, the borrower must intend to occupy the property. Okay. I've never seen a non-owner occupied FHA loan, but depending on the loan program that you use, you may not need to occupy it. Right, so VA guaranteed, also known as GI loans. The Department of Veteran Affairs can guarantee lending institutions against loss on mortgage loans to eligible veterans. Because the VA guarantees the top 25% of the loan, no down payment is required. Although no top limit is set for the loan, the VA will guarantee a loan on a single-family house in New Jersey up to $424,100 in lower cost counties and up to $636,150 in more expensive counties. VA mortgages, formerly known as GI mortgages, are intended only for owner-occupied property owned or co-owned by the veteran and may be placed on 1 to 4 family residences. Any questions? No? A VA appraisal is called a Certificate of Reasonable Value, or CRV.
Much easier than FHA.
Hmm?
I find the appraisals much easier than FHA.
VA?
Yeah.
Well, VA will take into consideration termite damage, so they need a termite report.
Yeah,
They,
that's understandable.
they need more, yeah.
Yeah, that's the only thing we need extra.
But
Other than that,
I think VA is more sensitive to appraisals, like things that they need fixed. I think you just had a bad appraiser that really was out to get you.
90% of years.
So eligibility. To qualify, a veteran must have a discharge that is other than dishonorable and the required length of service, 90 consecutive days of active service during wartime, 181 days of active service during peacetime, or 6 years in the reserves or the National Guard. Any questions on that?
My father was a veteran.
Huh?
My father was a veteran. I'm going to be alone.
If you're married to a veteran, yes. Okay. Okay. So the veteran applying for a VA loan must furnish a certificate of eligibility. Even though the veteran has used some or all of his or her eligibility to guarantee one loan, it is sometimes, and you guys need this highlight, so let me know when you guys are done. Okay. Possible to place another VA mortgage. Entire or partial eligibility may still be available if the first loan has used up only part of the guarantee, the original VA loan has been paid off, or the original VA loan was formally assumed by another veteran. Any questions?
So, if a VA already owns a property, which happens to be a single family, and wants to buy another property, but does not have the VA loan on the first property as a conventional loan, for example. Because I know once you have FHA or VA, you do only one time, right?
No.
Oh.
You can actually, for VA, you can use multiple times.
Okay.
FHA, you can do it if you move it 100
This
miles away.
scenario, they already have married couple, they have a VA loan, I mean a conventional loan, he can apply, being a veteran, can apply for a two-family?
If he's going to occupy it and it makes sense, yes.
What's the excuse?
Depends. Where does he live now and where is he moving to? Why is he moving from a single to a two-family? The thing that's so hard to convince an underwriter is why you're going to leave the comfort of having a single family where you have no tenants, you have your peace
Well,
at home.
the mortgage, let's assume the mortgage is on the wife conventional, he doesn't have one.
He doesn't have one?
No.
Then it's a lot easier. If he doesn't have a mortgage, it's a lot easier for him to go ahead and get it.
Two-family,
Yes.
no down payment.
No down payment. Just remember, tell him that he's got to occupy the property for at least 1 year.
Can he sell it within 90 days or not?
Can he sell it within 90 days? Why wouldn't he
I
be able
mean,
to sell it in 90 days?
I'm just being creative. Huh?
You're trying to do a rehab? That's mortgage fraud. If you say you intend to occupy the property for 1 year and then you sell it in 90 days, if you had that intention to begin with, it's kind of a little fraud going on up there.
Just ask.
All right, I'm just answering.
I did have a
Yeah.
No. I have a client who wants to do something like that. He wants to get into to a family. And we run it for a while, and if it makes sense to keep it, yes. Can he get out in 90 days? Can he get out in, without getting in trouble?
Is he going to occupy it?
1 year.
Is he going to occupy it?
It's gonna have to be that way. Has
It's
to be
going
that
to
way.
have to be that way.
And it has to be moving ready. No work can be done to needed to the property.
Right. It's kind of like FHA. Just be careful.
It may not be applicable.
If you smell a little fraud in there, I would run away from that one.
Just checking.
The FBI may not knock on your door tomorrow, but they may knock on your door a couple years from now.
I didn't borrow.
Huh?
I did not borrow.
You don't have to. You just have to be a part of the transaction.
So it's correct when you say it's easier for the underwriter to understand coming from a multi-family into a single
Right.
than going from a single to a multi,
Correct.
unless you move it a couple miles away. If you don't keep both,
It'd have to make sense. So like, let's say, for example, your kids are about to start school and you're going to buy a two-family in a very nice area where the school system is a lot better. That can be your reason,
and you keep the single family.
and you keep the single family as a rental. Okay? The widow or widower of a veteran who died of a service-connected disability and who has not remarried may use the veteran's eligibility. Okay. Any questions on that?
Don't get married. That's what it is.
When you use his benefits first, then you get married.
New Jersey Home Buyers Program. The New Jersey Housing and Mortgage Finance Agency offers below-market interest rate loans with low or no down payment to qualified borrowers who purchase homes in urban target areas, located mainly in inner cities. Outside the target areas, these loans may be available to first-time home buyers. Okay. I don't know why they put everything in bold and they didn't put qualified buyers in bold. That's just me. The loans are possible on 1 to 4 family dwellings and are not available to investors. Maximum allowable family income ranges apply depending on the size of the family and the county in which the property is located. Okay, it's a great program, but make sure that the client is qualified. Don't just go off the fact that they say, no, listen, this is what I'm going to use. Make sure that they've already gone through the process of being qualified for that type of mortgage.
Where do you find this program? Most banks offer it?
Through the NJHMFA.
So you have to sign up separately,
Yes.
or the bank have to apply for it?
It's its own program.
Own program.
And then when you go into that program, they'll let you know who you'll be working
Oh, this is like the institution for you to work with?
with. Right.
Gotcha.
They have their own institutions that they work with.
There's national programs, there's state programs, but these are great for people that are, this is for low and moderate income
Yes.
only. So if you make more than a certain amount of money, then you don't qualify.
Yes.
Right, okay. I never knew about this, nice. I learned something today.
Very hard to close.
Man, you trying to tell me I've been talking this whole
No,
time?
I
You only
didn't say
started
that.
learning now?
Sure, you know.
That's how I felt.
Oh, man.
For the basketball practice, right?
All right, so Farmer's Home Loan.
You were Charlie Brown until now.
That's it. Now let's see who wants to become a farmer. So Rural Economic and Community Development is an agency of the Federal Department of Agriculture that makes direct loans to borrowers. For low-income first-time home buyers, mortgage interest may be subsidized as low as 1%. All right. You good? You want me to read the whole entire summary or not?
Yeah, go through the summary. The most important part.
Saying over there, coffee break.
Oh, that's not coffee break, we're done. All right, so. Questions? It's a lot of stuff, right?
About the big loan.
Sure.
You have questions there?
Oh,
Not questions, okay, statements.
Adir doesn't like me.
Yeah, didn't like it. Sorry, it happens. All right, so do you guys have any questions you want to address? You gave business cards, right?
I did. I gave everybody a business card. Except Paul.
Except, I don't need it. It's okay. Close.
Now, let's say, the bank has the customer, is gonna leave it in the house. And if it's, but if his intention was not to leave the house, but decides the paper that, he's gonna leave it around. What consequences would you follow?
Mortgage fraud.
Huh?
Mortgage fraud.
Sorry,
Mortgage fraud. What's the consequence?
what's the consequence? That's it.
Oh,
It's
penalties. The FBI comes call you on a first name basis.
don't bring coffee.
Just that.
And the worst part, it's worse than mail fraud. It's worse than killing. It could be up to 30 years in jail.
Yeah, it's pretty bad. And the problem is that even though you may not have known, the FBI will come knock on your door if you're part of the transaction.
Yep. Exactly.
What is the statute of limitation on that? Let's say somebody does.
Somebody did.
Is the mortgage still in effect?
No.
Okay.
Yeah.
Then you're good. Right?
Yeah.
Just want to make sure.
You say that you would.
Feels like he's breathing again.
I can't tell you, there's a lot of people that try to use, has anyone heard of the 203K loan?
Yeah.
A lot of people try to use a 203K loan to try to flip a property. And it may not raise any red flags right away, but if you continually use it, there will be an investigation and they probably will come out.
So I'm okay.
What, a 203K loan? It is. But a person can buy a house and customize it the way they want.
It's true, it's about a headache. I have to-
Oh, that's-
You have to understand, every single program has its pros and cons. Every single program. There's no
Yes.
perfect one. And you need to know your client and their needs in order to get into these programs. Like I heard you say that these loans, both the farmer's home loan and the low moderate income loans, they're very difficult to close. Yeah, but depending on the clients you have, they know that they're gonna wait. They need it, they want it, get it done. It's not difficult to close because once they're approved.
Right.
The problem is the process that they have to go through to get approved. So you didn't use this.
I just mentioned because, I had a couple of those. Instead of regular, I'm not discriminating anybody, but I shouldn't say regular. Instead of other loans, right? So people can close within 60 days, 90 days, give it a taste. But these other loans, we have to go through being certified, you have to apply, you have to go through
Absolutely.
a long process. And I want 13 months to close, over a year.
Wow.
It could be.
Make close.
Absolutely, but that's what I'm trying to say. These programs are guided for people that have low moderate income, so you have to be careful in helping these people. So that's why when they go to get into these programs, they have to go to a seminar. But that's with them, not you. Once they're approved,
But,
totally different.
why is it difficult to close? Because, normally the regular, by experience, people, right? A regular loan, you're ready to close, closing is next week, and people go shopping the day before. Red flag, right? So this is within 3 months. Imagine now in a year what people do,
Absolutely.
especially the ones that are in need. They cannot spend money, they cannot do this, cannot touch this.
Absolutely.
And it's always an issue.
If their lease is up on their vehicle and they can't find the lease for the same amount.
Exactly. My car broke down, they had to get into another lease.
No, absolutely. But what I was trying to say is that there's pros and cons in everything, but it's still possible. We can still help people. You just have to understand your client. You have to understand the products. So a product like this, you're not going to bring just any kind of buyer. Somebody that's in a rush, somebody that doesn't understand what you just said about managing your debt, right? Somebody that cannot handle that stress with I cannot spend an extra dollar here or there.
I made a large cash deposit because I did an overtime somewhere.
Exactly. So
part-time somewhere. Explain where that came from.
that's why you have to understand your clients. That's the most important thing. When it comes to short sales, there's a lot of people that want to get into short sales and auctions and whatever. Most of these programs are worthless for those types of buyers. You want to get a conventional loan. Can you get the 2 or 3K for auctions? Sure. Just good luck. Deal with the headache. As soon as somebody comes with FHA and they want to go to auction, I say no. Not going to do it because it's a headache.
You can ask for extensions, because most likely they're not gonna close in 60 days or 30 days.
Exactly. And then the deal falls through, and then you just wasted your time. So you have to know your client. If it's a cash buyer, let's look at auction. If it's conventional, we can look at auctions. FHAs and everything else, let's stop right there. Let's analyze what's going to happen. Does that make sense? And then other types of programs, again, you go back to this. Now, I just want to make a quick point. Do you guys remember we talked about taxes, Chapter 8?
Yes.
Yep.
All right, so in Chapter 8, we talked about benefits for certain groups of people or certain types of property where there's deductions, right? So I don't know if you guys understood what Ricardo said here. It's highlighted. A farmer's home loan is subsidized as low as 1%. That means that your interest rate throughout the lifetime of the loan is
1%.
Not a bad deal, right? Now, because it's rural, right, so farmland, it could be farmland assessed. And that means what? Taxes will be reduced up to 55%. So imagine a 1% loan, up to 55% down on the taxes. You don't have to be the farmer. The property must be used as farmland. You don't have to be the farmer, so you can rent to somebody else. And within the 20 to 30 minute span, we can reach farmland. So imagine having an opportunity to get into these types of programs. Now, only mother's homes qualify. So depending on the county, a mother's home is only 500,000. So think about it. Yes.
Keep in mind, if you buy and you are a single person, you're gonna have to live with 2 other people.
I'm sorry?
You need 2 animals.
Oh, okay, the 2 chickens. You said 2 other people, I'm like, okay.
Other souls.
2 other souls, okay, yes, you have to have at least 2 chickens, a bunch of eggs. And you're good. Just save 2 eggs so you can rinse and repeat, okay? That's it.
Ricardo, I have a question.
Yeah.
Whose responsibility it is to advise the client not to spend, not to increase their credit cards, not to provide a bad card? Who really is the one responsible for doing that? So
The loan officer.
understands.
The loan officer should be the one to do that. However, if you want to give an added help, make sure your deal doesn't die, help out the loan officer, give him a couple of tips.
Yeah, so it's not your monkey, I got it. Just trying to bring up the fact it's not my monkey. Always bring him to the loan officer.
Yeah.
But have a good relationship, having a good relationship with loan officers, the title company, the attorneys and all that, knowing what they need,
Yeah.
so you can prepare your client up front is very helpful. All right, because then when he gets to his hands or whoever it is hands, then client is ready.
I've had attorneys help me out and say that also in the beginning of the process. But
When
I
I
closed,
tell them that, they always say, oh, my loan officer never told me that. I'm like,
I closed the loan. I closed the loan this past month that I have been working on for a long period of time. They ran into state 3 families, so they ran into like the green card issues, they ran into CO issues. It took forever to get the state to get inspected.
oh yeah.
So in that whole time frame, my client went to Colombia, went there for a month, family, came back. And the whole time, I told him right from the beginning, from pre-approval, you need to reduce your credit card debt. You need to bring down your liabilities as low as possible and keep it that way. Not just for this loan, but also to improve your credit and stay in a good credit range over time. We have to do a new credit report when it comes to 90 days. No, it's a credit refresh. We have to actually do a whole new credit report 90 days after the original one, because it is no longer valid. So my client went up $463 a month in payments. And he was already tight without, his DTI rate was super tight already as it was. So when I went to him and I told him, I was like, what happened to our conversation? He's like, well, you didn't tell me that I couldn't spend money on vacation, otherwise I wouldn't have spent so much money. I was like, dude, you're buying a house, your 3rd house, why would you do that? So when we closed it anyway, I found a way to fight it for him and we got it closed.
You committed fraud like that?
No fraud.
Just kidding.
No.
All right, so there's ways to get creative within the guidelines. That's pretty much what you're saying?
Yes.
Okay.
My client had a 4-family mixed-use property with a commercial loan, and I got him in a new 3-family with an FHA.
Interesting.
Yes.
Life-changing situation?
Nope.
Just right?
Into a better part of Elizabeth. He stayed in the same city and everything.
So life-changing situation. Better part.
Yeah. Better part.
You improved your life.
Yes.
So as long as it's a life-changing event, you should be able to
Right.
qualify for different programs or back to the original.
You have to give a motivation letter to the bank. Why you're going to be living in this.
You put tears on the letter too?
Huh? You put tears?
On the letter.
Yes, absolutely.
Teardrop.
That's why you hire a writer to do it for you.
All right, so it's possible to be FHA again.
It is.
Let's make FHA happen.
Is it every 2 years you can, like, if you purchase a property FHA 2 years ago, you can do it again after 2 years, or is it?
It's not a matter of time. There used to be stipulations where you can move into a better area, and they would allow it. If you, for example, had a baby, now your family got bigger, you can move into another multifamily home that's bigger. The unit you're gonna live in is bigger, so you will accommodate your new family member. Now, if you're just buying it for the heck of it, no. What they did is they took away a lot of that because a lot of people were taking advantage of that. So right now, the only real way that you can get another FHA loan is if you get one 100 miles away from your current primary residence. So if somebody moves job, like the Amazon guy, if you bought a house with FHA in New Jersey and then he moved out to Washington, you can go to Washington and buy a house with another FHA loan.
Or have a bunch of babies. You choose.
No.
Feelings, right?
That went out the door about a year or 2 years ago.
So the baby excuse doesn't work anymore. Alright. Right? Alright guys, any other questions?
Lunch?
Or lunch? It's only 12 o'clock, easy. You still have an hour and a half to go. No questions? You guys got everything? Don't ask me on Monday these questions, okay? You have him now, here, to ask the questions.
Well, Lewis is gonna come in the sun on Monday, I can tell you.
Especially the weekend's coming. He's gonna write down like 1,000,000 questions.
I'll be back.
Okay, Arnold.
Alright, Monday, it's a tough chapter. It's the third chapter of mortgages. We're gonna talk about what happens in the primary markets and secondary markets, loans bought and sold. We're gonna talk about Fannie Mae. We're gonna talk about closing regulations and stuff that's very, very boring. But I get stuck with it because none of the loan officers want to teach it. So,
I told
Oh,
two
yeah,
or three of those already.
and you said no more. Please keep me to chapter.
No, because I looked up and everybody was like sleeping. Throw
It's
come down.
Sunday Super Bowl, correct?
It's football, yeah.
Sunday.
Yeah, but the
So
class isn't
nobody
on
shows
Sunday.
up to work on a Monday.
Okay. Right.
No,
There has to be something here.
people,
Sorry.
people with good
Sorry.
work ethic show up to work on Monday.
All right, guys. Have a good weekend. See you.
Nice meeting everybody. If you guys have any questions, you guys have my card.
Thank you.
No problem.
Here.